So we're just going to spend a little bit of time talking about the CEA tonight, and appreciate you again your willingness to give us a few minutes. We're going to talk briefly about why the CEA was established almost better than a quarter of a century ago, what it is we're here to accomplish, how we manage this risk. And I know that there's nothing more interesting than listen to an insurance guy talk about insurance and finances during what should be a happy hour, but I promise to keep it brief and give the background necessary to explain why we've made some changes lately. And we'll go over those specifically. And then, of course, we're also here to answer any questions that you might have. So with that, why don't we get started? And we'll go to the first slide and we'll get rolling here. Briefly, CEA was established back in the mid-90s to be an earthquake insurance provider in the state of California. I'll talk a little bit more about how we were set up in a moment. But today we insure over 1 million policyholders. We're structured uniquely. We have a lot of money to pay claims if a really big earthquake happens. We also have a program to help older homes get retrofitted. We call that our Earthquake Brace and Bolt program. Some of you may have heard of. We're proud of that program and have a little more information about that tonight. And then just for your information, that's not all we do, because a few years ago, the legislature gave us an additional responsibility, and that is to oversee this thing that's called the California Wildfire Fund, a $21 billion fund that provides some financial protection in case an investor in utility and its equipment causes a wildfire. There's some funds now to help in that scenario, and it's a fund that needed to be administered, and the legislature came and asked us if we could take that on, and so that became a responsibility of ours too. But we're here really tonight to talk about earthquake and earthquake insurance, because in this state, of course, earthquake risk is real, and you all know that. California is home to 2/3 of the nation's earthquake risk. Right there, situated on that map, is 2/3 of all the risk in our country, as primarily indicated by those lines that run around. Those are the faults that lie underneath the Earth's surface. Of course, the big gash that runs along the West Coast, the San Andreas fault, the mother of all faults here in California, but that's not the only fault. It fingers out and produces a number of different fault segments really throughout the state, and most of California's population lives in close proximity to one of these faults. You can visualize San Diego, Los Angeles, San Francisco, and where a good share of the population is, and all the metropolitan areas in between. So earthquake risk is real, and this is earthquake country, and almost everybody is exposed to it in some degree or another. And so this is an important topic. Now, by way of background, some way back in the 90s, back when the personal computer was invented in 1984, California passed a law that says if you're an insurance company selling homeowners insurance in California, you have to offer earthquake insurance. It's not covered in the basic homeowners policy, and that's important. That's an important point. Somebody's not covered just because they have a homeowners policy. They're not covered for earthquake. You have to buy a separate policy. But beginning in 1984, companies received the mandate to offer it when they sell a homeowners policy. That worked fine for the first 10 years or so. Companies were offering it. They weren't charging much for it. They didn't really understand the nature of the risk. And then this happened, the Northridge earthquake in 1994, a devastating, deadly earthquake. I'm sure some of you perhaps were around at the time, maybe lived through that terrifying experience. Lives were lost, $20 billion in property and residential damage caused. After that period of time, most insurance companies concluded they really didn't want to be forced to offer earthquake insurance anymore. And since the law required them to do it, they decided not to offer homeowners insurance anymore because they didn't want to be forced, stuck with the obligation to offer a separate policy. And the homeowners insurance market crisis back then was far deeper and more widespread than the challenge we're even facing today as a result of all the wildfire activity in the state. Couldn't buy homeowner insurance back in the mid-90s because of this mandatory offer. So the legislature acted and established this organization called the California Earthquake Authority. They took a whiteboard, they kind of figured out how to do something that never been done before. They put this unique organization together But essentially, how it works is companies were offered the opportunity to join the CEA. Once a member of the CEA, and they had to pay to join, paid a lot of money to join, but they then helped form this organization, which then was there to provide earthquake insurance to the customers of those companies who joined us if they wanted to buy a separate earthquake insurance policy. But we were given some other special responsibilities too. We're required by law to charge rates that are actuarially sound. We're required by law to make sure those rates are based on best available science. We do all of that, and we receive no public funding. We're entirely privately funded through the insurance premium that our policyholders pay us. We're not in the state budget. We're not a state agency. Policy holders pay premium. We manage that premium, that income we receive from them to manage the risk and to provide the assurance so we can honor our promise when the big earthquake occurs. And then finally, we function on a not-for-profit basis. We're a public created organization, created by the state laws, governed by a governing board that's elected officials. The governor, the insurance commissioner, the state treasurer are the voting members of our board of governors. The two leading members of the legislature are non-voting members, but these public officials who are there to serve the public make sure that this organization is too, as they govern the activities of the CEA. So we're pretty unique. There's no other really insurance company like the California Earthquake Authority, really anywhere in the country or anywhere in the world. These are the companies that joined the CEA either then or over time. These are our participating insurance companies. In order to buy a CEA policy, someone must have their homeowner's policy through one of these companies. But if they do, and they're insured with, let's just say State Farm or Farmers or Allstate or any one of these companies, when that company offers a policy to a new customer, they must offer a separate earthquake insurance policy. But even if they're not offering new policies, when they renew their existing policy, they must again extend an offer to their customers that if they want to buy an earthquake insurance policy, they can, in which case they'll be buying a CEA policy. We take all comers, meaning we don't sit back and say, that house is too risky. We don't want to insure that person that's trying to buy. That's not how this organization operates. If someone's insured with one of these companies, and they want to buy earthquake insurance, they're guaranteed they'll get it from us at a very specific price that they can find out on our website, and we'll go over that a little more in a second. I also have talked just a little bit about our financial structure. We every year amass an incredible amount of claims paying capacity. This fancy tower is really an illustration to depict all of the capacity we have today tonight as we are visiting to pay claims on behalf of our million policyholders if a really big earthquake, God forbid, should happen while we're talking. Almost $20 billion claims paying capacity is at our disposal. Now, some of that comes from the premium that we've collected and that we have invested in very secure investments. That's what you'll see in that blue bar, the blue box at the bottom, CEA available capital. That's dollars that have come in and we have at our disposal to pay claims. But that's only $6 billion. And that would not be enough to measure up to the tremendous financial strength that the CEA wants to have on behalf of our policyholders. The current objective, the current goal of the CEA is to have enough in claims paying capability that there's only a 1 in 350 chance that an earthquake or earthquakes will occur in any given year that'll exceed the amount of claims paying capacity that we have. So that's pretty good. Only a 1 in 350 chance. That's less than 0.5% a likelihood that an earthquake would be bigger than would exceed our claims paying capacity. And if it was, let's say we only wound up with 98% enough. Well, first of all, that would be the biggest natural disaster the world's ever seen. But secondly, we'd be able to pay claims on we'd be paying claims on 98 cents on the dollar because it exceeded the total amount that we had assembled. So that's CEA. We're uniquely structured. We're uniquely capitalized. We only sell earthquake insurance only in California, so we don't have other lines of business that we can draw upon for additional claims paying capacity. We're the CEA, and we're here to provide earthquake insurance for those customers of our participating insurers who want to buy a policy. Next slide, please. All right. We've experienced change over the past decade, change that continues to be very fluid today. And I want to spend just a second talking about those changes. If you look back now 10 years ago, which seemed like a long time ago in many ways, and other ways, I think we can all remember what we were doing 10 years ago, and in some cases just like that. But if you look back a decade, the CEA issued policies to over 800,000 policyholders. We insured over 842,000 homes we insured. The total insured value of all of those homes, if you add it all up, the total insured value of all the policies that we provided was over $300 billion, that's a lot. And we don't have $300 billion ready to pay claims, but we're pretty darn sure that not a million of our policyholders are all going to get completely destroyed in one event. That's not going to happen. But that's how we have to measure our exposure, is totaling up all the insured value of our policies. And back then it was $313 billion. Now, even back then, we didn't have enough in invested money. We hadn't collected enough in premium to be able to provide a level of claims paying capacity to handle that level of exposure. And so really from the beginning, since the CEA it was formed, much of its claims paying capability has come from what's called risk transfer or reinsurance, which some of you may have heard of. Most of you may not, because it's kind of a backroom term that really only insurance companies deal with. It's simply insurance for insurance companies. So just like a homeowner has a home and they want some help with the risk that their home might be ultimately destroyed someday, they don't want all that risk on their own shoulders. They buy a policy from us, and we insure that home and another home and a million homes. And we obtain financial protection for all of our policyholders by buying insurance protection for the whole bunch. It's called reinsurance, insurance for insurance companies. So if there's a massive earthquake, it exceeds the money that we've collected and invested on their behalf, the reinsurance companies have promised to pay claims through that reinsurance policy that we have purchased from them. It's just insurance for insurance companies. And back 10 years ago, we spent $200 million on that reinsurance protection. But that protection gave us the assurance that we'd be able to pay claims for a really massive event. So it's expensive, but it's important. And it's the only way, frankly, that any organization can manage the risk of a large number of policyholders for one risk in one state that's heavily concentrated in the earthquake country. But that was back then. So let's fast forward to today. Number of policies has grown pretty significantly. We're over 250,000 more policies today than we had 10 years ago. A 27% growth, 2012 to 2022. The total insured value of all those homes has grown much more than 27%. It's more than doubled. It's more than doubled, and that may seem strange because the numbers only increased by 27%, and yet the total insured value of all of our homes has increased by over 100%. Why is that? Inflation. As we bring on more homes, inflation keeps increasing the reconstruction cost of each and every one of our homes. That creates more and more exposure that grows faster than the number of policies that are coming in. It's not uncommon. It's a factor that is common throughout insurance, but it's a reality that we deal with as we manage through this growth of exposure that's occurring, primarily because of inflationary costs, especially given the last few years when there was a time we were seeing historically high inflation levels. So the insured value of all our homes has increased a lot. The insured value of your home has increased a lot over the last 10 years, especially over the last several years. And the total total insured value of all of our homes has more than doubled to now more than $600 billion, more than $500 billion in total exposure. This, of course, has required us to go out and purchase more reinsurance than we purchased before, a lot more, to handle all of that increase in exposure, to deal with rising reinsurance costs as reinsurers keep getting hit by more and more natural disasters, hurricanes here and earthquakes there. The price of reinsurance has gone up over the last several years. So we've had not only the need for more of it, but the price we pay for it has gone up too. So the overall expense on our reinsurance coverage that we obtain on behalf of our policyholders it has gone up 122%. Now, this year, last year we spent almost $500 million a year on our reinsurance protection. It's going to be more than that this year, and it's just the reality. It's the costs that we need to absorb to maintain the financial strength that we have on behalf of our policyholders. So, to deal with these factors, several years ago, we began to foresee that if we didn't make some strategic moves, this large increase in exposure, this even larger increase in the cost to reinsure that exposure, all those costs are borne by our policyholders. If we didn't somehow begin to figure out how to deal with these historic times we were moving into, the amount of rate increases that we would have had to pass on to our policyholders would have skyrocketed. And of course, this public enterprise doesn't favor doing that. We're not in this to make a buck. We're in this to protect our policyholders. And so we began to take some very specific strategic steps to reduce the pressure on the need for rate increases, the pressure that we're seeing across our country and world as these natural catastrophes continue to mount. One thing we did, one of several things we did, was to pull back and modify some of our coverage options. And I'm going to describe those now after first describing what our current policy, consists of prior to these changes. We insure the replacement, we insure the structure, we insure the home, how much would it cost to rebuild that home if it's destroyed in an earthquake? Not its market value, not what you'd get if you planted a for sale sign in front of the home, but how much it would cost to rebuild that home if it's totally destroyed. That's what we insure that home for, plus other things as well. Personal property inside the home. We back when reinsurance was prices were falling and some science findings were helping us a little bit in terms of the amount of risk that was perceived at that time, we were able to increase our coverage options. The state law only requires that an earthquake policy have $5,000 worth of personal property. And for a time, we were able to increase that a lot and offer people up to $200,000 worth of coverage for the things inside their home. That's changed now, and I'll talk about that more in a second. But that's what we were able to grow the policy up into back when we could afford, when our policies could afford it, and we could insure more homes. We also offer up to $100,000 to our policyholders if they need money to live elsewhere while their home's being rebuilt. The state law only requires $1,500 by way of additional living expenses. That's enough to, get you a hotel room for a few days, and that's not going to be sufficient to get you through the recovery stage. So we were able to increase that to $100,000 of additional living expenses, and some other things too. We offer a mitigation discount for an older home that was built before building codes got strengthened. But if that home takes this effort to mitigate that home, to do a retrofit project, simple retrofit project, takes a couple days, a few $1,000s, maybe $5,000 or $6,000, depending on where that home is located. But if that step is taken, we can reduce that premium by 25% because the risk of that home becoming a total loss has been dramatically reduced. So mitigation discount, I believe we're the only company that offers a mitigation discount of this size. Maybe others offer it too now. We've had this on the books for several years, and we're proud of the effort that we've taken to encourage owners of older homes to retrofit and make that home safer. Deductibles, we offer a wide range of deductibles from all the way from 5% up to 25%. The lower the deductible, the higher the premium for providing more coverage. The higher the deductible, the more the homeowner's basically self-insuring their own risk. which allows that policy to be reduced in premium. The choice is the consumers, and we have a wide range of deductibles available, and some other things. When some work's being done, we offer coverage to upgrade the building code to which that home is being rebuilt to, up to $30,000 for a building code upgrade. We also added on some extra coverages, the masonry veneer that wraps around the bottom of homes. Sometimes we insure that. Some breakable items beyond appliances, but things that break that aren't necessarily essential to the daily life, but represent breakable items. We offered coverage for that as well. And finally, we added on a what might look like a little thing, $1,500 worth of emergency repair. But this little add-on comes in very handy after even a small to moderate sized earthquake. A moderate sized earthquake like happened up in Humboldt County end of last year. Some of our policyholders, while their home might not have been totally destroyed, they had some damage, and they had gas lines were broken, and they had to get some things fixed in an emergency basis, and they had some coverage to help them do that. So that's where our coverage options were when we decided we need to make some changes, and not just on coverages, but other areas. But we did make some changes to our coverages as well. Some things we didn't change. We still insure the full replacement value of the home. We still insure $100,000 for additional living expense coverage, far beyond what the bare bones minimum is by state law. We still uniquely offer a 25% discount in building code upgrades and emergency repair coverage. Those things we offered before, and we're going to offer going forward. Those items have not changed. Where we have changed are in these areas. We're lowering personal property coverage. The maximum now going forward that a policyholder will be able to buy is $25,000 for the things inside their home, not coverage for rebuilding the home, but for the stuff that one accumulates inside it. Now, the maximum amount one can purchase with a CEA policy is $25,000, which is 5 times more than the minimum that's required by state law of $5,000. Those deductibles I talked about, we still offer 5 to 25% deductibles, but if the home has a replacement value of over $1 million, then that homeowner is only going to have a 15 or 20 or 25% deductible. Higher value homes, we're saying they're going to need to shoulder a little higher deductible and incur, self-insure a little bit more of the risk, so we can keep our coverage more broadly available and affordable for as many Californians as possible. And we frankly eliminated those ancillary coverages I mentioned ago. Not many people were buying it, and it added to the total exposure that we had to buy reinsurance for. So those are the changes we made. And now let's talk about who all was impacted by them, or the magnitude of our policyholders who were impacted. About 30% of all of our policyholders had personal property coverage in excess of $25,000. So when their policy comes around for renewal, their personal property would be reduced to $25,000. 70% of our policyholders will not be impacted because they already purchased less than $25,000. The big majority of our policyholders not impacted by this change, but 30% are. And we're taking steps like this to make sure that people realize this change is coming and why it's coming, and how it's part of an overall effort to keep the cost of the overall policy from requiring an incredibly large rate increase. The next change, those deductibles I mentioned, we're limiting the 5 and the 10% for older non-retrofitted homes and for homes in excess of $1 million. Well, 93% of our policies will not be impacted by that, but 7% will. For those who have an unretrofitted home, of course, they can fix that by getting their home retrofitted. Then they can keep their lower deductible and get a 25% discount besides. But I'm not minimizing the fact that 7% of our policyholders will be impacted by this reduction in deductible options. And then finally, those add-on coverages, the masonry, veneer, and the breakables. You can see here that very few of our policyholders purchased that coverage, but it added to the overall cost that everybody had to pay on behalf of all of our policyholders, because our exposure was increased because of that coverage we had out there. So we made a strategic decision to eliminate that add-on coverage that we added on a few years ago, again, to help guard against the need for a very large rate increase. So to summarize this discussion on coverages, this is the current CEA policy going forward that policyholders will be able to buy from the California Earthquake Authority. Insure the home. Insure contents inside up to $25,000. Get that that money to live elsewhere if that home's been badly damaged. Additional living expense coverage. A mitigation discount that's I think leading the market in terms of an incentive to older homes to get retrofitted. Lower deductibles still for most policyholders. We've talked about those who are losing their lower deductibles, but what some might be able to do to preserve it, and in those other coverages that you see here, none of those are changed. This represents coverage that would allow somebody to get through a major earthquake, to have the financial strength to rebuild if that home has been badly damaged or destroyed, and to have access to funds to live elsewhere while that work's being done. So we're moving to focusing really on what's most important, the home where families live, the dollars necessary to incur life's expenses that come while that house is being rebuilt, the things that are most important to the financial survival of a family if a home has been badly damaged. That's what we're focusing on with the policy going forward with these changes that we've made more recently. How much does how does this impact the cost? How does one find out how much a policy would cost them? If someone's listening tonight who doesn't have earthquake insurance, but you want to look into it, well, call your agent for one thing, and they'll help you. But if you want to just do a little digging around yourself, go to our website, earthquakeauthority.com, and click on that button there that says free estimate. There you can click into that and quickly get into a premium calculator, which will allow you to put in some basic information. What kind of policy do you want? Are you a homeowner? Are you a renter? Etc. Select the kind of policy that you want. Tell us a little bit about your home. What age? How old is it? What's the address? Put in some information into this premium calculator, and then you are in the driver's seat because you'll get to a page that looks like this, where you see those sliders, the little buttons down below. You activate one of those buttons. You can move it to the left or to the right, and increase your coverage or decrease it. And as you move through the options that are available, you can keep your eye on the bar up in the upper right-hand corner and see how your premium adjusts based on the coverages that you choose. So you can play with some of these options, get the policy that meets your own needs and budget, and let your agent know that you want to insure your home with the California Earthquake Authority insurance policy. Now, I also want to mention that you'll have other options available to you. And this public enterprise isn't concerned about building market share. We don't view other insurance companies that are out there providing earthquake insurance as competitors. We think California is best served by a marketplace that has more than one earthquake insurance provider out there providing valuable coverages. And there are other companies that do just that. To name a couple, GeoVera, Palomar. There may be others that your agent will be able to help you locate. It's frankly worth anyone's while to do a little shopping around, and for earthquake insurance too. And for agents that are listening, we want you to know that you're not restricted to just place your customers with a CEA policy. You can investigate on their behalf what a policy through one of these other companies would cost and how the benefits stack up, and help your customer arrive at the decision of the policy that's best for them. Next slide, please. I want to switch gears here just for a second, and we're going to get to your questions. Before we go into that phase, I want to talk a little bit about mitigation and the importance of everybody, regardless of whether they're insured or not. They live in an older home, let's say built prior to 1980, especially in a home built prior to World War II, say before 1940. The importance of reducing the risk that home's going to be badly damaged by undertaking a retrofit. And here's what I mean by that. A picture's worth 1,000 words. We took this picture the morning after the Napa earthquake. Driving around town, looked at the damage, came to these two homes. One was fenced off already and was obviously in a state where you couldn't live in it. That's the yellow house on the left. The blue house looked good. It looked strong and usable. Turns out it was. The owner of that blue house came out. We talked to him and learned that house had been retrofitted a number of years ago. They'd gone into that crawl space between the earth and the main floor of the home and put in braces and bolts and tied that home into the foundation more securely and prevented that house from doing what happened to the yellow house, just slumping off the foundation. Retrofit works. And we have over 1 million homes in this state that need that kind of project. So the state law asked us to take on a responsibility to do what we can as this public organization to help. We developed this program, Earthquake Brace and Bolt program. When funds are available, we have a program whereby we basically run a lottery and encourage people to sign up. And if their name is selected, they'll have the chance to then receive a $3,000 grant if they get that home properly retrofitted. The zip codes, because funds are not unlimited, the funds are targeted on the zip codes that are highest in seismic risk and highest in concentration of old buildings. But it's a list of zip codes that continues to grow. This program continues to grow and spread throughout the state, focusing in the highest risk, but spreading out from there, providing grants to help people who live in an older home get retrofitted, whether they have a CEA policy or not, or an earthquake insurance policy or not. This program is available for all. We've retrofitted 20,000 homes so far, 21,000 through this program. Other homes have been retrofitted simply by seeing contractors are out there doing the work, and homeowners who have taken the step to do it on their own time and their own dime. So many more homes than 21,000 have been retrofitted over the past 10 years, which is a good thing. But we need to keep at it because we know that there are so many more homes that need it. If anyone listening has an older home, pre-1980, say, you want more information about steps to get that house retrofitted, here's a great website that the team here developed. It's called strengthenmyhouse.com, filled with all sorts of information about ways in which you can take steps to make that home more secure. Strengthen my house. That'll conclude my remarks, unless you have anything else for me. I just want to end by thanking everybody for allowing this evening to happen.